All right, so it's a pretty interesting conversation on today's episode. Frank, we actually broke down HSAs decently in a recent episode, and it's kind of cool because Beth's question here is going to help us go more in depth on it and really isolate and focus on it. So this will be interesting. She says, I max out my HSA every year, but never actually pull any money out of it for medical expenses. If I just keep doing this every year, am I understanding correctly that I can build up a huge HSA balance that will be tax-free throughout retirement?
Well, first, a couple things. Congratulations, Beth, on maxing out your HSA, utilizing the tool, and actually not pulling money out of it. She may be the only person that has ever posed this question or is actually using your HSA correctly. So kudos. Maybe she needs a job here. So I think HSAs are actually one of the most underutilized retirement planning tools in America. People do not take advantage of them. And again, we did talk about this on another episode, but it is the only triple tax benefits tool that the IRS has ever created for us, right? So not only do you get a tax deduction on every dollar you put in there, you're also able to grow that money tax-free and pull the money back out tax-free for qualified medical expenses. Unlike any other retirement account the government has built for us, like a traditional 401k or IRA, you get a tax deduction when you put it in, like the IRA, but you pay taxes on the back end when you take it out. Roth IRA is tax-free on the back end when you take it out, but there's no deduction when you put it in. So the HSA is the only tax-free on the back end and tax deductible on the front end. Okay, and I think people don't understand that you really are only receiving a tax benefit on the growth, right? If an account doesn't grow, so if there's no growth in the account, you're not receiving tax-free growth. Does that make sense? So you're only taxed on growth anyway. If you put money in an account and take it back out and didn't let it grow, there would have been no tax benefits on the growth because there's no growth.
You would just have the benefit of the no tax on putting it in.
You would have got the tax deduction. That's exactly right. But I think you would have missed out on the other two tax benefits. Okay, so if you put something in and take it right back out, it would probably come back out tax-free anyway, unless it was a retirement account and you're subject to the pre-59.5 penalty. But when you put money in an HSA account, the best way to utilize that account is to let the compounding effect grow those assets inside of that HSA tax-free for an extended period of time. Can you imagine if you got 20, 25, 30 years of compounding effect inside of an HSA account and you maxed it out every year, how much tax-free dollars you'd have in retirement? And who knows how much medical expenses, we're going to need in retirement. But would it make you feel good if you had a few $100,000 sitting in an HSA account that you could access tax-free? Exactly. And if you still needed some of those funds, you could utilize it like an IRA. At that point, after 65, it would be taxable if you didn't use it for qualified medical expenses, but you could still access the funds.
So that's the big caveat, because people might be saying, well, why is that so good? Sounds too good to be true. If I can put money in tax-free and take it out tax-free, why wouldn't I do that? Well, it's because it still has to be used for medical expenses.
Correct.
Even 30 years down the line.
Correct. You can still track those expenses. So all of your out-of-pocket expenses that you've accumulated for years and years and years, they're all digitally archived, right? You can go back and pull those expenses, take that grouping of all of your out-of-pocket expenses for 10 years and use the HSA account once it's compounded and grown to go back and pay those expenses as well. So a very flexible account.
It's a very powerful account, and hopefully you're taking advantage of it like Beth is. Beth, you're on the right track.
Nice job, Beth.
Great job. Just realize those small caveats and how they get used later down the line, but usually it's still a very compelling reason to utilize this opportunity.
Agreed.
So, great question. If you have similar questions like this, you might benefit from a consultation with Frank and his team at Oliver Asset Management. They're based in Longmont, Colorado, and you can meet with them by scheduling a time to visit right from your smartphone or computer. Just check the link in the description of today's show, and you can book a call or a meeting with the team. Again, you can have that introductory meeting, and that can be in person or on Zoom if you prefer to meet remotely. That opportunity is there as well. Frank, thanks for the help.
Thank you, Walter.
All right, we'll see everybody next time on The Time Blueprint.
Thank you, everybody.
Investment advisory services offered through Creative One Wealth LLC, a registered investment advisor. Oliver Asset Management and Creative One Wealth are unaffiliated entities. Licensed insurance professional. This information is for educational purposes only and should not be construed as advice or a recommendation for your specific circumstances. Investing involves risk, including possible loss of principal. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. We are not affiliated with any government agency and do not provide tax or legal advice.